You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. I hope that you had a great weekend. Mine was pretty filled up with a lot of things. So I'm starting the week a bit tired, but it's like good tiredness. You know, when you your life is full of great things. You just sometimes you feel like you would sleep a little bit more, but at the same time you have that fire burning. This is how I feel today. Anyways, today's podcast is about when playing safe is actually riskier than taking real action, or just trying to be on the safe side could actually hurt your portfolio and cost you a lot. The idea of that show came up because someone on my YouTube channel said, "Yeah, Mike, going back to your story in 2017 when you received your pension plan, it was like a good move to invest right away. Everything at the end of 2017, even though the market was trading at a all-time high, but it was incredibly risky to do that, and it should have been in a better way, putting that money to work, but just investing it through several months, or just to wait for a dip, because this strategy would have been a lot less riskier." So I thought giving some thoughts about that, and then I started to think, yeah, maybe if you invest a lump sum of money today and tomorrow is the beginning of a major market crash, in that case, you're probably right. It is a riskier investment strategy to invest everything in one shot. However, as I told you, I think it was a week or two before, there's a study done by JP Morgan where they actually proved that between 1988 and 2020, so August of 2020, so we include COVID in that, if you invest in any day versus investing at a all-time high, well, actually in 88% of the time, investing in all-time high 12 months later, you will show a positive result, where if you invest on any day, it will be 83% of the time that you will show a positive result. So stats are telling us that sitting on the sideline or waiting to invest for a few months or for a full year is actually a lot riskier than investing everything today. And just for fun, I went back in time and looked at the real case study, because it's interesting to always look at financial literatures and theories. I like JP Morgan's example because they did a monk work to go for more than 20 years looking at every single day. If you invest today and then tomorrow and the day after tomorrow, what is your returns going to be in 1, 3, and 5 years? And in all cases, investing at all-time high was the best thing. So in other words, if you invest at any moment, it's a good moment, but even if you do it at all-time high, it's not that bad. But I decided to look at my own experience, and then I looked at my portfolio value throughout 2017 all the way up to 2024. So of course, today it's easy to say I made the best decision. I have all the data, and I average more. I showed a annualized growth rate close to 14% right now. So 14% annualized return since 2017. I'm at 13.58 if you really want to be precise. Still pretty solid returns. But then I was looking at what would have happened if I was investing every month throughout a year. So actually, if I had done that, I would have paid a lot higher price between 2017, September of 2017 to September of 2018, just benefiting from a market drop between July and September. So the last 3 months or so, I would have started to buy at a little bit lower price. Actually, it would be a declining price, but not as low as 2017. Because in fact, even at the bottom of the bear market of in 2018, my portfolio value was still higher than the original amount. And that like happened very quickly. You know the story. It was on Boxing Day on December 26th, and right after the last trading days of December and the first 2 weeks of January, it was already surging back up. So just waiting 2-3 weeks at that time to see if it was really the bottom or not, you would have lost like 10-15% on the market in opportunity cost. And then fast forward to 2020, the index, if you follow either the TSX 60 or the S&P 500, was trading below the 2017 moment, like in September, like at that price. But still, when I looked at my portfolio, I think the lowest it went back then was around $125,000, where I invested 108. So even at the lowest, after the worldwide pandemic that would kill the entire market and kill us all, yet portfolio was still above what I invested in 2017. So long story short, if I had waited or invested gradually over several months, I would have lost money in terms of opportunity cost. But that is real money because you have that choice today to either invest or to wait. But if you wait, it costs you money. It's not true that it's a neutral impact. If you have $100,000 right now and you decide to put that in a GIC of like 4% or 5%, at the end of the year, after 12 months, you're going to make $5,000. But if the market is up double digit and it's up like 12%, well, your opportunity cost is $7,000. Like you have to calculate that as money lost, because in two alternative scenarios, one gives you 105, the other one is giving you 112. So you cannot discard that part when you start to invest. So trying to invest in a safer way actually means to try to invest to minimize volatility, not necessarily risk. And when you try to minimize volatility, there is a cost to pay. Some investment products will do that for you, but there's a fee. You could also decide to have a good portion of your portfolio invest in fixed income to reduce volatility, but that's also a cost to pay. There's an opportunity cost over there. And now I'm not saying that it's a good thing or a bad thing. I mean, if you cannot withstand that kind of volatility and you don't want to see your portfolio going down 10, 15, 20%, well, chances are you should not invest a big portion of your portfolio in the stock market, but at the same time, do not expect to generate high returns. You cannot have everything in finance. I mean, there's no free lunch. So if you have less volatility, you will pay it with less returns. If you want to have more returns, you have to live with fluctuation. That is just normal. So when you think that something is safe, it's actually less volatile, not necessarily less risky, because over time, the best performing asset is always equities. And if you invest in with a long-term mindset, thinking in decades, the safest place to be, by definition, is actually investing in the stock market. So trying to play safe is actually playing less volatility, but again, if you just are able to ignore that noise and keep steady with your strategy, you're golden, because you're going to not mind about volatility and actually benefit from a higher total return, even if you're retired. And I keep hearing that. And it's kind of funny because when I started my service at Dividend Stocks Rock, was the same thing. People were saying, yeah, it's easy to make money. Like, let's wait until the next 5 years, until the next 10 years to see how you go. So now we're 7 years down the road. The strategy works. It's performed well. It brings me a lot of conviction, which is a lot more important than anything else. And then now people are saying, yeah, but Mike, that strategy doesn't work when you retire. So unfortunately, you will have until I am 65, 70, maybe 75, until you decide that I'm old enough, but I will have the same strategy because that strategy gives me a lot of conviction. Now, if you want to start on a good place to find great stocks, I suggest that you download the Rockstar list that I've built. This is a list that I update monthly. So every single month, you're going to receive in your email mailbox an updated list with several metrics that we use at Dividend Stocks Rock with a positive dividend triangle. So that list is North American-based companies showing positive revenue growth, earnings growth and dividend growth over the past 5 years. You can download it at moosemarkets.com/rockstars. moosemarkets.com/rockstars. And tomorrow, I'm going to teach you how to pick the best companies from that list. So that list is a great starting point. It gives you a list of companies with strong financial metrics. And when you have strong financial metrics, well, chances are you narrow your chance of getting very good investment in your portfolio. So you can download it at moosemarkets.com/rockstars. And I will teach you tomorrow how to use that list. All right, Moose, that's enough for today. Enjoy your day. It's pretty sunny here. And until tomorrow, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.